We have managed to string together 2 days of rally. And I know the S&P 500 was down. That collection of stocks was down yesterday. However, yesterday was led by the ARK stocks. ARK was up significantly yesterday, as was the collection of stocks in the ARK complex and stocks in the innovation space, tech, high beta stocks outside of the ARK complex. Those stocks are again leading today, obviously quite dramatically. So the way I view it is that's just a continuation of what happened yesterday. We had some change, some shift. The area of the market that was being hated the most, all of a sudden, was being loved the most. Or at least there were no more haters around to continue hating on the stock. The shorts had shorted, the sellers had sold, and all of a sudden, you just have people who view these stocks as quite attractive at prices they haven't seen since March 2020, and only for a very brief period of time at the very bottom of the March 2020 crash were these stocks at these prices. So we're seeing incredible value here. But I don't want to get too ahead of ourselves. I'm not saying that some massive, growth tech rally is going to occur. I'm not saying some massive S&P 500 rally is going to occur. We've obviously had a steep decline. And as the title of the video suggests, stocks take the elevator on the way down and the stairs on the way up. So what I'm expecting is a move higher. I think we have bottomed. I think, I've heard some people explain some very logical explanations for the level at which we bottomed. Right at the line of the bear market, official definition. As we've said in the previous video conversations with clients, we actually think the economic situation is good. And the market should really only enter a bear market if the economic situation is bad. Obviously, the dot-com bubble is its own thing. There was a total mismatch between valuations and earnings. I don't think that's happening here. We discussed that again in that Conversations with Clients video where we talked about all the macroeconomic things that you would want to know. All of them. That was a great video. I have received praise for that video. And I would encourage you to watch it if you haven't already. Particularly if you think this market goes down from here, because we certainly don't think so. The market rejected, for now, the bear market territory level. S&P 500 did. We'll call it the market. And I think I like that move. Now, I'm not saying the S&P is not leaving its bull trend and we're destined for new all-time highs. I think the previous all-time highs are too expensive. Now, we could surpass them if inflation continued and earnings growth continued because inflation continued, but I actually expect inflation to come down. And last year, I was a big-time inflation hawk. I've been all in on the energy trade, and I still am. But I think inflation is going to end. It's obviously gone on a while. It's obviously been quite extreme. I'm not trying to say inflation is no big deal. I'm not trying to say I'm a dovish person, okay? I was hawkish, and I was very much in the inflation camp previously, shorting bonds, all that. But I have shifted. I'm now in the inflation is cooling camp. We've gone from 0.8 month on month, 1.2% month on month. Those two reads for February and March, if you annualize those, they're quite high. You then get into April, you get 0.3% month on month. That is 3.6% annualized. I think that's a number we can live with. I think that's the Fed's year-end projection. I think we can live with that kind of number. Next, what matters is what happens next, right? Where do we go from here? Well, the Fed seems to be ending its monetary expansion. Consumer sentiment is low, so I'm not expecting, some massive increase in spending. I'm expecting spending to stay stable. It is strong, but stable. And I'm expecting China's supply chains to come online. They have been offline for about a month or more now. And once those come back online, all of a sudden we get chip production going, a lot of other stuff, and we may begin to see that maybe we'll stay, below or around 0.3% or get to 0% month-on-month inflation. And then all of a sudden, we're not talking about inflation. It's simply we have inflated. Prices have gone up and they have stayed up and it has been flat. I don't think prices are going to come down without a recession. I don't think we need prices to go down. The wages have gone up. What we need is stabilization. Not prices to decline, but stabilization. And I think we can get that stabilization if we can get China's supply chains online. A couple other things, obviously energy is a big wild card here. That's why we're remaining in it. But I think things are looking good. I challenge the bears to make a full case with data for a recession, because I've been trying to do that. I've had a lot of people, discussing, and obviously for obvious reasons, like many people fearing a recession. How could you not in this market? But, I've taken all of that perspective, all of those insights, et cetera, tried to piece together, can we get a recession here? And as of right now, all I'm seeing is there is no clear, follow through case for a recession. I'm not seeing a recession right now. I'm just not. I'm seeing a strong economy that may not grow as fast as it did when we had massive stimulus, but I think that's okay. And that's why I don't think we should get back to new all-time highs. I think the all-time highs previously were too expensive. PE multiples were quite expensive because they were expecting further growth at a high rate. We have to take those rates down. But I don't think that means we need to crash the market another 20%, right? This is quite a dramatic decline. We have more stocks down 75 and 90% than March 2020. There's been tremendous carnage. Microsoft, Apple, they're still pumping out good cash flows. So maybe Google is going to see a little bit of an ad hit, whatever. We don't need to be, putting record every second. We just need to have stabilization. Let's stabilize here. Let's let these innovative companies innovate and build things for the future and open up new industries, etc. And not get killed 80-90%. I think that was excessively done. So I'm heavily weighted there. I like my current positioning, innovation type stuff that I think is fundamentally sound. For example, Jumia trading at 2 times revenue. We were concerned about 100 times revenue. That is the largest e-commerce platform in Africa. All of Africa, it's multinational. You talk to anyone in Nigeria. I talk to people in Nigeria on social media. I talk to my Uber drivers from Nigeria. They're all familiar with Jumia. So for less than what it was yesterday, less than $500 million, you best believe I am in that company. So there are names that are in the innovation space that I think are good. I know a lot of people hate Cathie Wood. That's all I was hearing like 2-3 days ago. Even from clients who are trusting in me enough to put their money in my, control essentially. And but that's my conviction, and it's my job to have a conviction that is well thought out, well analyzed, well strategized. And I'm here recording these videos to share that conviction and those findings, those insights, those opinions, and that analysis with you. So I hope we've made this clear. Most important thing to remember is stocks take the elevator on the way down and the stairs on the way up. So let's not expect anything too crazy, but let's also not be scared by, a Monday down 0.5%. We can't be scared by that. Even if it's down 1%, we can't be scared by that. We just have to remain calm, look at prices, look at valuations, look at the lack of, in my opinion, a true sound recession case. I think it was just kind of compounding on itself. S&P decline, S&P decline, S&P decline, higher rates. I think rates have capped out unless there is something massive to come from the Fed selling its balance sheet, but I don't think it's going to do so at a tremendous rate. I mean, there's hedge funds bigger than what they're going to do like the rest of the year. So in terms of bond sales. And there's plenty of foreign nationals, nations, etc., that are happy to buy our debt, particularly with the U.S. dollar this strong. And Goldman Sachs has dropped their high yield forecast to 1.9%. So of 1.9% default rate. So if yields end up going up at the higher end, I think there will be plenty of buyers in there. I think people will actually buy that debt. And it's not like the Fed is going to be dumping the debt and there's going to be no demand and all of a sudden yields are going to skyrocket to the limit. I don't think that's going to happen. So that's today's video. And until next time, peace out. Have a good weekend.